Ray Dalio has asked the question, are we in a bubble? He provides historical context, some charts and facts to give us a reminder of where we are at in the cycle. I think it's important to step back, zoom out, and ultimately realize that everything operates in a cycle. We cannot escape this natural occurrence despite the audacity of the central planners suggesting that they can do just that. The arrogance or flat out deception, depending on how you want to look at it, should be appalling to the general public, but instead they are sold on the lies of more and more for everyone free of charge. You came here for the truth, so let me unveil that for you. If you've gone any number of years throughout your life, the one thing you realize, or the one thing you come to realize, is that nothing in life is free. You've got to pay somehow. Oh, it's a free service? Meanwhile, they're taking your data. They're taking your information. Oh, get a free this or that. Oh, by the way, they're taking you on this and that. It's always somehow going to get you in the end. There is no difference when you look at what the government does. Oh, let's give you a free service. That's right. But meanwhile, you're paying through your taxes. And then you see the same thing with the central banks. We're going to make sure the bubble goes on and on and on and on forever. There's no such thing as a free lunch. Today, we're going to talk about what Dalio had to say. I told you I would cover this. This is the video. Then we're going to look at all of these different charts and articles that are connected in with what's happening today as it relates to the bubble like we've never seen it before. Let's go. Okay, you can read the whole article if you wish, but I'm showing you the most important charts, the most important points from what Ray Dalio had to say. This chart here is showing you the current conditions compared to previous bubbles. On the left-hand side, they're basically just showing you the description, and that ranges from prices are high relative to traditional measures. The next one is prices are discounting unsustainable conditions, and so on. And then it just shows you, based on the different bubbles that we had, the roaring 20s, the dot-com bubble, 2007, and then on the right hand side we are seeing two that are broken up by today total market and today emerging tech. So you can see the differences between the two, and it is very clear. You look at the roaring 20s, in every category it was bubble, and then you got one that was frothy. In the dot-com bubble, everything was a bubble. And then you look at 2007, there was no bubble in two of the categories, frothy, and then we got bubble. And you look at today's total market, and according to Ray Dalio and the findings that they have at Bridgewater, they're showing us that it's overall not a bubble. That's what he's trying to depict here. However, emerging tech shows frothy and bubble for the most part. So that's the way that he breaks it down. Now it goes into much more detail, which I'll show you here, but it depends on the statistics, the indicators that you are using to determine this information. And again, it doesn't have to show that everything's in a bubble for that bubble to burst, okay? You can see what happens along the way, and there's a failure somewhere. It could be in the smallest thing. We were told the subprime crisis was small, it was contained, there was never going to be a worry because everything was so diversified, and yet we realized how rotten the mess is underneath. And then, of course, they went on to just continue business as usual. In brief, the aggregate bubble gauge is around the 77th percentile today for the US stock market overall. In the bubble of 2000 and the bubble of 1929, this aggregate gauge had a 100th percentile read. So according to this, we're not quite there yet. But of course, this just gives you some insight once again, comparing it to the previous instances as they're circled in red there. It doesn't mean that you can't have some sort of collapse or a crash or a correction because of this particular indicator, but I just wanted to give you some insight on that. And you could see right here, it is at what he says the 77th percentile or 77%, and that is historically very, very high. And that's all we need to know for this point. There is a very big divergence in the readings across stocks. Some stocks are, by these measures, in extreme bubbles, particularly emerging technology companies, while some stocks are not in a bubble. The charts below show the share of US companies that these measures indicate being in a bubble. It's about 5% of the top 1,000 companies in the US, which is about half of what we saw at the peak of the tech bubble. The number is smaller for the S&P 500, as several of the most bubbly companies are not part of that index. So that just gives you some insight of what's happening here. Shows the charts comparing the top 1,000 companies to the S&P 500, but it just gives you an indicator that we are going into a place that, just looking at it 2 years ago was virtually non-existent according to these indicators, and now it's starting to pick up steam dramatically. Again, we don't have to have the same repeated patterns. It doesn't have to be at the numbers it was in the previous bubble to show you that. All we need to see are the trends. We took the stocks that are in bubbles and created a basket of the bubble stocks to keep a close eye on them. The chart below shows their performance and the performance of our basket of the top 500 companies. This market action is reminiscent of the Nifty 50 in the early 1970s and the dot-com bubble stocks in the late 1990s, both of which I remember well. It scores similarly to the bubble stocks of the late 1920s, which I can't remember because I wasn't alive then. And essentially what you're seeing here, the red line, that, by the way, this is returns since the start of 2020. That's the bubble companies, and it's approximately 350%. And you look at the top 500, it's hard to tell on here, but it's, let's say, 25%. So there is a clear disparity in between those so-called bubble companies and the group below, the top 500. This gives you an idea of how things have been growing, if you want to call it that, since March 2020 up until the present. There's been some clear outliers that are just surging. They've gone crazy. Certain stocks have really, really lifted over this last year or so, and that hasn't been because of fundamentally things have been sound. No, not at all. It's early on they would say, this is a forward-looking mechanism, the stock market that is. It's a forward-looking mechanism, and therefore we can just see past the problems into the future and simply price stocks that way. Of course, they don't do this all the time. I think it's a little silly because you could see what happened to stocks. They fell significantly. They shouldn't have fallen in the first place if they were just going to overlook that. That's not the way it works. It's a lot to do with liquidity. There's no doubt about it. And when people start to feel fear and the algorithms feel that fear, the sell-off will go on. Now, of course, the Federal Reserve somehow believes that they can, at least they tell people, they can prevent the cycle from continuing and simply stop it in its tracks and push it higher up. That's the belief. That's what they tell people. But ultimately, we know that this can't be the case because this has never happened in history before, and they're not ever learning their lesson. That's a fact. I'm going to end the video there. If you found it informative, give me a thumbs up, please. I really appreciate that. Something I want to post once again. I want to talk about this. I've been, mulling this over for a while. Let me just be frank. The financial side of this business continues to dwindle. Okay. And there are many factors for that. You can ask me. I don't mind talking about it, but essentially that's dwindling away. So the time that I'm spending on these videos gets longer and longer and longer over time. And so that's obviously not a good business that keeps dwindling and you spend more time on it. But anyway, part of the decision that I'm making here is that I would like to work with somebody else on these in terms of financially. I don't know how much I can afford to pay somebody something like this, but what I would want to work with somebody on is basically 5 days a week. We can work sort of side by side. I don't know how this would all work. Just me thinking off the top of my head. Somehow to spend an hour a day, let's say 2 hours a day at most, to put together these videos in terms of the research aspect, and just to do something different with this channel. let's just say the output would be the same, but the way that things get designed on the back end would be a little different. I don't even know. I've always done everything myself. This is, in terms of the research, I've always been a one-man show, as you know, just trying to dig into all of this. But it looks like things are definitely changing. Nobody really cares. The vast majority of people definitely don't care about the information, and that's okay. I still want to do these videos. I still want to make these videos. There's absolutely no doubt about that. But I think it would be great to be able to work with somebody on the other side of this as well. So that's just something I wanted to mention anyway. So we'll talk further about that. I think, let me know what you think in the comments as well. If you want to learn about e-commerce for free, you can go take the person's course I just saw, $2,000 course. That person just made up to $10 million in sales. You can take that course, or you can learn for free at the AmazonGPS.com. I'm a fearmonger, and I'm only there to make money. So you can check it out at the AmazonGPS.com for free. If you want to learn about making money, foundation, history, the asset class, everything to do with the financial system, it's all in these 2 books. You can check them out at the link in the description. And if you haven't seen this video already, you definitely want to check it out. Click it, and I'll see you there.